Well, hey there, everyone. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from kind of a perfect late summer, early fall day here in Redmond, Washington. Nice and cool, decent breeze. Sky is clear. Happy to announce that. Market overall doing just fine as well. Coming after this week's Fed meeting, which was the story yesterday. At the end of the day, it wasn't much of a story. I mean, there's a lot of choppiness, but the market sort of hung in there going into the close today. Nice move higher in the first hour of trading, and although the S&P settled down a bit through the remainder of the day, the other 5.5 hours of trading, that initial spike was enough to push the S&P to a new high. So we're closing just above 6630. You're going to see that actually small caps were the real juice today, with the Russell 2000 finally making a new high after failing to do so recently. A lot to be encouraged about, right? Sentiment data, we'll update you on that with the AAII survey coming in a lot more bullish than last week. Name exposure index we'll cover as well. Also some gappy upside moves in technology names like Intel with the $5 billion announcement by investment by NVIDIA or whatever it was. I'm going through some of the I'm summarizing some of the details, but the chart will speak for itself in terms of the gap to the upside. A lot of charts to review, some individual stocks, because there are actually some things breaking down today. We'll talk about FactSet making a new 52-week low today, and others struggling on earnings. But at the end of the day, at a high level, right, starting macro, going to micro from there, the S&P up about 0.5%. As you can see, this morning was the story. The first hour of trading accelerating to the upside, pushing above 6650. By the end of the day, we were down around 6632, but that's still enough to be up 0.5% for the day. The NASDAQ composite up 1%. We're going to show you how our newer Dow theory, looking at the equal-weighted S&P and the equal-weighted NASDAQ, arguably back to a confirmed bullish reading, with the equal-weighted NASDAQ making a new 52-week high today. Mid caps and small caps up even more, though, and the S&P 600 small cap index up 2.25%. That's your best performer. Russell 2000 having an equally impressive day. Small caps are getting it done here, no denying. The VIX unchanged from yesterday, so we're moving higher on fairly low volatility. No real spike in vol. No real spike in skew, no real spike in those things that would say, credit spreads, right? All of those things kind of remaining in long and strong. Things are kind of good types of ranges. I think those are important charts to follow because at some point that will no longer be the case, but not today. Conditions still pretty hospitable here. Rates generally moving higher today. You can see bonds sold off. The TLT was down about 1%. Dollar down about 0.5%. Rates generally moving higher. 10-year points around 4.1%. What's interesting is even with this week, with the Fed lowering their target rate with expectations for further reduction in rates here in the meetings to come, home builders actually struggling here in the last couple of weeks, and their mortgages are more tied to like the 10-year point, right? That's a little more longer term. Where as a rate where mortgages are derived from, and that part of the curve is actually drifting higher this week post Fed. So 10-year yield around 4.1%, long bond yield almost to 4.75%. Looking at the commodity space, kind of mixed here. Silver ETF SLV was up about 0.5%. Gold, the GLD, was down 0.4%. Energy prices slightly lower. Natural gas, the worst of all of them here. So overall, not a great day for commodities after energy's had a bit of a bounce recently, but coming back down today. Looking at cryptocurrencies, pretty good news, I would say. Bitcoin toying with 118,000. It's currently just below 117,500. Ether prices around 4,600. Most of the top 10 coins on the stock charts platform in the green today. I did grab one of the I forget if I grabbed a Bitcoin ETF or if I grabbed Coinbase, but I'm pretty sure I grabbed Coinbase. We'll see here in a little bit when we get to the charts. But, crypto charts generally kind of improving here, and Coinbase certainly seeing a nice upswing as well. All right, looking at the 11 S&P sectors, pretty decent up day, generally speaking, with technology back at the top of the list. Tech up 1.7%, industrials up 1.1%. Then a big gap down to healthcare. So worth noting, right? While this felt like the biggest up day in history, and that I'm exaggerating, felt like a pretty decent update. You saw how big small caps are. Note that only two of the S&P sector spiders out of the 11 had a decent gain today, right? Technology up 1.7%. That was really the big mover. Industrials number two, and a lot of those industrial charts like GE Aerospace comes to mind, making another new all-time high this week. Industrials up 1.1%. Then you have a big gap down to healthcare, which is up less than 0.25%. Then you have a group of sectors that were basically flat for the day, and then you've got some consumer sectors that were both down. So it wasn't as great of a day in terms of sector breadth as you would think, right? I mean, it wasn't like all of the sectors were up in a big way. It was only a handful of sectors that actually, created the gains that drove the market higher. Having said that, you look at broad breadth data, so that's more sector breadth. Look at the broader group of breadth data, and it's actually quite encouraging. About a 2-to-1 ratio on the S&P 500, up versus down. About the same for the New York Composite Index, about a 2-to-1 ratio. About a 9-to-1 ratio when you look at the small cap space. As I mentioned, small caps are really impressing this week. And today, probably one of the better days we've seen here, with small outperforming large, with the Russell 2000 breaking out. We'll talk about the relative performance of those two, because it actually has started to favor small caps here in the month of September. What else can we say? I would say with the Magnificent Seven and friends, these leading growth names, you have NVIDIA up 3.5%. That was obviously the big announcements with NVIDIA, with the additional investment into Intel, propelling Intel up a pretty big way. But NVIDIA also gaining 3.5%. Alphabet up 1%. That's after the gap higher that we saw. That was Monday. We had another big gap higher, but it gapped higher a couple weeks ago, right? Beginning of September. It's been a kind of a nice steady incline. Last couple of days sort of stalled out. Today drifting a bit higher, though. The open and close were almost identical, creating a bit of a doji candle. Tesla down over 2% today. That is the dreaded dark cloud cover candle. One big up day, a big down day. Day two engulfs almost all of day one. It doesn't quite get below the previous day's open. Netflix also trading lower today, down 1.7%. Apple slightly lower as well. All right, we're going to go to the heat map. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. Those of you that are tuning in live, welcome. Thanks for joining me live on the daily live stream. Please drop questions in anywhere you can as we go. I'll grab a question or two at the end of the episode. Anything we don't get to, we'll put in the mailbag. We're planning an all mailbag episode tomorrow on Friday, September 19th. We'd love to answer one of your questions there. And if you're watching later on our YouTube channel, questions always welcome. Just use a comment section on our YouTube channel. I read every one of those questions that comes in because I find it so valuable just to see what you guys are asking about. And please send in your questions anytime. By the way, latest episode of the Market Misbehavior podcast in the editing room at the moment. Hope to get it to you probably first thing tomorrow morning. I caught up earlier today with Peter Krull. Pete is a portfolio manager based in North Carolina. He's at a firm called Earth Equity Advisors. He's just releasing a book in November called The Sustainable Investor. And I met Peter years ago at a conference, reached out to him when I heard about the book coming out. He sent me an advanced copy. It was really, really interesting. Great discussion about kind of like the evolution of sustainable investing, sort of the socially responsible investing, ESG, whatever you want to call it. We talked about all those acronyms and how investors should be thinking about that space going forward. Some of the challenges of evaluating companies based on some of these different metrics, how you relate those sort of idealized conditions versus actual stock performance, and how ESG related investments have performed. It was a really interesting conversation. I love being able to ask an author great questions about the books that they've written. So should be out very, very soon with Peter Krull, and I hope you can enjoy that when it is released on our YouTube channel and on all the podcasting platforms. All right, looking at the heat map today, Just obvious. What jumps out to you? For me, it's two things. Number one would be the strength in the left third of the heat map, particularly the upper left corner, which is technology. The gains we saw in tech today were pretty remarkable. We've talked about the sort of rotation away from technology, or at least the fact that technology started to underperform in August. Some other sectors kind of stepped in a new leadership role. Things like communication services and consumer discretionary, for sure, but also some impressive moves in industrials, in financials, as we've talked about. Today was kind of back to the mid 2025 playbook, kind of tech and then everything else. Industrial is probably a close second in terms of general shades of green in the sector. But you've got Nvidia up 3.5%, Palantir, and a bunch of other stocks up well over 5%. A number of the semiconductors, MU, LRCX, Applied Materials, KLAC, they're all gapping higher with the along with Nvidia and Intel and all the others. I've got CrowdStrike up almost 13% today. Western Dig up significantly. Synopsys up over 12%. Pretty remarkable day for technology. So the growth trade is not over just yet, is what today's price action is teaching me. Let's continue to follow trends as long as they themselves continue, and we're seeing that certainly in the technology sector. Within financials, some interesting charts. Of course, Blackstone. We highlighted the bull flag pattern continuing to push to the upside, but I'm noticing some red here, particularly some of the payment processors. Visa and MasterCard both down about 2% plus today. MasterCard has been the better of the two, testing new all-time highs yesterday, but today kind of giving those gains back with potential support around 580. With Visa, probably I'll have to look a little bit lower, around 330 or so, but some short-term support there. And then you've got kind of the, market data kind of index provider area. So S&P Global down almost 7% today. FactSet down over 10%. Moody's down almost 6%. Market Access, these are some of the market data companies. The NASDAQ, the Exchange Group, MSCI, they're all kind of rolling over today. Now, FactSet is a unique one in that it's been in a well-established downtrend for quite some time. But like S&P Global had been making new highs at the end of July and now has completely changed, broken below the 50-day and much more today. I grabbed a couple of those charts and for the life of me, can't remember which one. So I'll wait and find out with you here in a few moments because I grabbed them earlier in the day. Also, final observation here, the strength in industrials. We've been talking about some of the defensive, and I don't mean defensive like defensive sectors. I mean defense like aerospace defense types of stocks. GE Aerospace making yet another new all-time high. You've got Howmet, HWM, threatening another new high, kind of testing previous resistance from the end of July. Then you've got kind of traditional manufacturers, heavy machinery kind of names. Caterpillar continuing to break out after that coil pattern we highlighted on the show last week, continuing to rotate higher. Man, price patterns still work. So before you question whether price patterns work, look at all these bull flag patterns and coil patterns. When they resolve in a certain way, it's, just classic technical analysis, but I would argue it's still working okay by my read. All right, we're going to get to the charts here in a few moments. Before we do so, just a couple quick announcements to share with you. I will be doing a free webcast next week. I would love for you to join me for that free event that's coming up next Wednesday, September 24th, 1 p.m. Eastern, 10 a.m. Pacific. I'll be doing a session called Trend Following 101. Learn the rules, follow the moves. I have found that a lot of unsuccessful, what I like to call mindless investors, if you're struggling as an investor, I often attribute that to a lack of consistency in your routines, underdeveloped routines. And we're going to talk about a routine, a set of routines to use to better understand the trends that are happening around you. I find a lot of investors get in trouble, not because they make poor decisions, it's just because they don't have a consistent process to set themselves up to make better decisions. And we're going to talk about some of the ways you can apply trend following techniques in your own portfolios. You can sign up for that free event at marketmisbehavior.com/trend. Again, that's coming up next Wednesday, the 24th, 1 p.m. Eastern. While you're in the entering URLs mood, you can also go to marketmisbehavior.com/money show. If you are in the Orlando, Florida region or can get there next month, about a month out, mid-October, I'll be speaking at the Orlando Money Show. I'll be doing a presentation called The 4 Pillars of Investing Success. We'll talk about technical analysis and 3 other key disciplines, how I use each of them in my approach, how I relate them to one another, and just some tips and tricks that I've picked up from working with a lot of successful investors on how to manage those different kind of areas of your process. Again, you can sign up for that event at marketmisbehavior.com/money show. It's an in-person event in Orlando, Florida, coming up in about a month. I'll also be recording some episodes of my podcast from the event. I hope you will come say hello if you do attend that event. Always a pleasure to meet some of you guys in person. All right, let's continue on here looking at some charts. The S&P daily chart continuing to go up, right? And there's, I always describe charts as innocent until proven guilty or guilty until proven innocent, right? What's kind of the idea of trend following, something we'll talk about next week, is I think your goal should be define the trend. Is this chart going up, down, or sideways? That's the first thing you do. Then you start applying other things onto that. And in this situation, clear uptrend, and we've got a bunch of tools to help us define that. It is in a clear uptrend. Most simply, the fact that it's making higher highs and higher lows. So the general idea to following the uptrend is, as long as we continue to make higher highs and higher lows, this is a pretty strong chart getting stronger, which means you want to look for what would make this chart no longer making higher highs and higher lows. So 2 things could and eventually most likely will happen. Number one, we'll make a lower peak, right? We will attempt to make a new high and fail to do so. We haven't really seen that since the April low, right? Every time we've made like a decent thrust higher, we've made a higher swing high. And I think that's one of the things that is a great reminder, something to reflect on when you look back at 2025 and what you learned. I think for me, it's the strength of the trend off the April lows and just trusting the fact that when we keep making higher highs, that's bullish. All new highs are bullish, except for the last one. That's what one of my mentors, Greg Morris, has said. And so what you have to also remember is at some point, the price will break down, right? It will. At some point, it'll break down through support and be in at least a cyclical downtrend. So we can also look at the recent swing lows, which is why 63.50, I think, is still an important level to watch. It's about 300 points below current levels, but we could easily get there in some sort of significant pullback scenario. I think anything above there at this point is still okay. So the market for now, higher highs, higher lows. Is it unusual that we're seeing this much strength in September? Very much so. September, without a doubt, the weakest month of them all by most look-back periods you could come up with. And we've often have weakness in August and September, usually setting up a major low and then setting us up for significant gains in the fourth quarter. What does this mean that we're completely ignoring the seasonality? Well, it reminds me to not trust as much on seasonal tendencies as much as the actual trends themselves. A number of guests I've had, like Chris Verone comes to mind, always making that great point that, look, at the end of the day, the trend is the trend. So it doesn't matter what I think should happen. If the trend is up, I'm going to want to own that thing. And if the trend is down, I'm going to want to not own that thing, generally speaking. Trend is up for stocks, still remains that case. Now, we've had some evidence that we've highlighted in July and August. We've tried to be very transparent when tools in our toolkit are starting to flash warning signs. One of the warning signs we saw in August was a bearish non-confirmation. That's using a technique called Dow theory, where you have 2 different indexes, in this case, the equal-weighted S&P in the top, the equal-weighted NASDAQ in the bottom. Are they both breaking out? That's bullish. Are they both breaking down? That's bearish. Is one not confirming the other? That is called a non-confirmation potential reversal signal. We've actually had 2 non-confirmations so far off the April low. The one was in June when the equal-weighted NASDAQ made a new high and the equal-weighted S&P did not. That was negated and turned back into a confirmed bullish signal at the end of June when both of them once again resumed their uptrend and made new highs. We've had a similar situation here July into August where the equal-weighted S&P made a new high. The equal-weighted NASDAQ did not. For us, that's a bit of a red flag. Saying, all right, potential non-confirmation. Any breakdown would be pretty significant. We talked about some of these levels we would look for, like 182 on the equal-weighted S&P, 97 on the equal-weighted NASDAQ. We never broke down. To the contrary, the equal-weighted NASDAQ actually made a new all-time high today. So now, in the last week. We have the equal-weighted S&P and the equal-weighted NASDAQ both making new highs this month, which basically means that non-confirmation no longer valid. We have a confirmed bull market according to newer Dow theory. Let's talk sentiment here for a minute. When we're looking at the AAII survey, this is a weekly survey of individual investors. Here's what happened last week. Last week, we were down here around 30% bulls, 48% bears, I want to say. Both of those numbers have gone to a much more bullish tilt this week. The bears actually reduced down to 42%. The bulls increased fairly significantly up to over 41%. That means the spread between the two is only slightly more negative than zero. So we've got a 1% gap of bears over bulls. That means we're pretty much even in terms of bullishness and bearishness. I get nervous in this sort of environment when we've had the run that we've had, and investors start to get skeptical. They start to get nervous. They start to get less bullish. You can see that like in December of last year, January of this year, we see those lines start to go down. For now this week, encouraging, I would say that the sentiment has gone more bullish. If we would continue higher, I'd be looking to see if and when that would get above 50%. That can often be a warning sign that investors are getting too bullish for now, sort of back to a fairly constructive bullish reading. Name exposure index, while there was a big move in the AAII survey, not much of a change in the name exposure index. The AAII survey is a survey of individual investors. The name exposure index, that's the National Association of Active Investment Managers. So it's a group of money managers and basically how they're allocating or how they describe their allocations to equities. Almost no change from last week. I mean, a tick lower, but not by much. So no real significant message, I would say, either way. When that indicator gets above 100%, I start to be concerned about euphoric levels of over bullishness. We're not there yet. More room to run potentially. Two relative performance charts I wanted to share with you today, and the format of both these charts is identical. We're just looking at one index or ETF versus another. Here we're looking at semiconductors, the SMH relative to the S&P 500. If the line is going up, that means semiconductors are outperforming the S&P. The line's going down, we're underperforming the S&P. You can see that in August, we went from sort of being a market performer to underperforming. And this is when the technology sector started to underperform the S&P itself. This is when other sectors like communication services and consumer discretionary started to improve on a relative basis. In the month of September, talk about turning on a dime. From Labor Day to now September 18th, this relative ratio has gone almost consistently higher, which means semiconductors really starting to outperform. Now, obviously, just today, we've got the news with NVIDIA and Intel, both of those stocks up, and Intel up quite significantly, which is certainly a part of the SMH. But a lot of the other semiconductors all rallying pretty good today. And that means semiconductors once again outperforming. That's one of those bellwether groups. Usually feels better. I mean, it's easier to be bullish when those stocks are going up, in my opinion. But, for now, kind of getting back to that point. But what's interesting is it's not just about big mega cap tech and communications names. Small caps are beginning to outperform as well. And we had a question on this earlier this week or last week. I forget. And we looked at the chart of the IWM kind of testing resistance today. We actually made a new high. We actually broke above that resistance we were talking about. That's what we were waiting for. You can see that the relative performance of the Russell 2000 versus the S&P breaking out above its 200-day moving average. So really starting to show since the end of July that small caps really starting to outperform. Certainly, if you've been ignoring small caps for a very long time, I don't blame you because they have been ugly. Generally, this space has been underperforming for years and years. But the last 6 weeks are showing a significant rotation into small caps in a way we haven't observed in quite some time. All right, finishing off looking at some individual names. I mean, Apple stands out to me as stalling out here around 240. I mean, still this chart is pretty good. And I would say, still for me, innocent until proven guilty. Do we keep making higher highs and higher lows? I'm watching 225, right? When I have a chart like this that's in a clear uptrend, I always think, all right, what's that level? What's that stop, right? If I had a long position directly in Apple, which I personally don't, but if I did, like at what point would I maybe question that long position or at least think about, taking part of that off the table? 225, I think, is a really good spot for an alert. because what that would mean if we broke below 225, that would be the swing lows from August and September. That would be a 38.2% retracement of the way down from the December 24 high to the April 24 low. Or the other way to think of that, it's a 61.8% retracement of the way back up. That was resistance back here in March. That now has become support. It's what we call a pivot point. The 50-day moving average kind of right about that point. 200 days slightly lower, around 221. So I probably look at 225, 221 as those potential stop levels. Anything above there is still pretty good. Anything below that level, that's a breakdown. For now, Apple's holding in there okay, and I think that's good to see. Intel, as I mentioned, gapping higher. I mean, this is one of those times where the chart up until today has been neutral at best. I mean, if you look at the chart, we've sort of been in this broad basing pattern with 18 to 19 on the lower end, 25 to 27 on the upper end. And at some point, right, we break out of that pattern to the upside. Today, we've done it on a huge, obviously, gap higher. Now, this is a name, obviously, in the news with, significant investment announced, which is causing the price to gap higher. When you have a gap, right, a lot of times it can be almost impossible to predict a gap. I don't know how many people yesterday said, Intel's probably going to gap up about around 25% tomorrow. Just not something you would normally expect, right, to just kind of happen. But when it does, where charts can be helpful is gauging what happens after that. So let's start gathering data about what we've observed, right? So initial assessment, we gapped up to almost 32. We closed down below, more around 30.50. So we've closed below today's open. Anytime you have a gap higher, the question is, do you have additional buyers coming in willing to accumulate shares at this much higher price point, right? This is a stock that all of a sudden has been basically it's like an anti-coupon. Instead of getting like a 20% off coupon, you're getting charged a tax of 23% just to buy Intel, starting today. So are people willing to pay even more than they had been? And if so, the chart's going to reflect that because we're going to gap and run. We're going to run higher going into next week. But if not, another scenario is we start to gap lower, start to fill in this gap. Below 30 would be a concerning development along those lines. It's not just about semiconductors, and it's not just about Intel and NVIDIA. CrowdStrike, which is in the software group, also gapping higher. This is after a fantastic bounce off of the 200-day moving average. I love to see that. And the rotation higher today, getting back above the 50-day moving average, getting back above this dark cloud cover pattern, which looked kind of ominous going into the end of August. We are overbought. We are approaching the previous resistance, which means if you've not been in CrowdStrike, I probably would be waiting for a confirmed break above 520, which would clear that previous resistance. But nice gap higher so far. Not everything's going up there. We highlighted some of the names within financials. It wasn't the big banks and things like that, kind of the other groups like exchanges, index providers, market data companies. This sort of like the other part of banks outside of like regional banks and money center banks and insurance companies kind of have this other bucket within financials of kind of other names, and SPGI going down big time today. I wasn't able, I looked quickly to see what sort of news flow is related to this. I couldn't find something specific that I would say this is why this stock is down. I'm sure at some point I will discover that. But for now, from a technical perspective, not good, because this breaks down through the 50-day moving average, which had been holding through yesterday's close. Also closes below the 200-day moving average. Last time we closed below the 200-day was here in June, and we very quickly had buyers come in and push the price higher. So, looking to see if we can hold that level, that 500 level, and if not, if we continue to deteriorate going into the weekend, that's a pretty much a downside validation on SPGI. FactSet Research Systems is a brilliant reminder of why I personally don't like buying falling knife kind of charts, right? Yesterday, this is going into earnings. The stock's rolling over yet again, making new 52-week lows. Earnings today clearly did not go well because the stock is down over 10% today. So FDS has been in a primary downtrend, right? We've been making a pattern of lower lows and lower highs. We've been below downward sloping moving averages. Most recently, counter trend rallies in August and September have stalled out below the 21-day EMA. This is why that sort of setup is one I just completely avoid almost entirely, unless it's some big, long, like in a retirement account. I remember this with like cannabis stocks. I'm like, look, these things, I think they're going to do better than that. Like they're not going to zero, I don't think, at least for the foreseeable future. So am I happy buying something in completely beaten down? I remember doing that with Disney when it was getting absolutely crushed. And I'm like in a retirement account. It's like, I think Disney's going to be around. I think it's a great story, great company. At some point, it's gonna recover to the degree that that's going to be a good investment. Those have both worked out okay so far. Cannabis not as much. That's still a pretty rough group, but starting to improve, I guess, a little bit here in 2025. But very rarely, and from a technical perspective, I would say hard to justify looking at charts like this going into today and thinking there's a lot on the chart suggesting it's a good reversal. And that's why I think being patient for signs of accumulation are helpful. At some point, a chart like FDS starts to rotate higher. Not today. Final chart, Coinbase. And I've been, we've highlighted the chart of Bitcoin, some of the ETFs like IBIT that have, broken out, pulled back to their previous breakout level, and now rotating higher. I think you're seeing Coinbase do that here as well. 300 is sort of the floor, 295 to 300. That's the level here. We've about a 6-week period from early August to mid-September. But this week, we're sort of pushing to the upside, back above the 50-day. I think Coinbase, pretty encouraging now that we're getting back into this gap range. I think above the 50-day means upside follow through, particularly with the RSI pushing above 60. I think that's a nice upside rotation. All right. Thanks so much, as always, for watching. And thank you for the questions that have come up here. Let's take a question or two. Jeremy, thanks for watching live on YouTube. You said Zebra, ZBRA. Let me bring up that chart. Not one we've talked about often, if ever, on here, to be honest with you. Gapped above the 50-day moving average in May. That's back here. And retested successfully a few times. It got above the 200-day moving average and then had a big, scary red candle. I love that. With tons of volume. It closed above the 200-day moving average today. Buy or wait. Oh, what a great chart. What a cool chart to bring up here. Zebra is not one that I've looked at very often. You mentioned the volume, which, as you probably know, I rarely have on my charts, but I'll pop it on here. Oh, yeah, I see what you're saying. We can also color the volume, and I'm going to do something else here. I don't really need to see this, but I would look at like the Chaikin money flow. Right. So remember with volume, right? There's two ways you can think about volume. You can look at the daily volume reading, which is fine if that's what you want to do. And plenty of people have done quite well with that. I tend to be much more interested in trends in volume. So I think indicators like Chaikin money flow that actually show you volume and how it's evolved over a look back period, just a little more helpful at understanding how volume is progressing as opposed to just thinking too much. But having said that, big sell-off day on heavy volume, that's a problem. That was earnings here. You can see on August 5th. So, we went from making a new swing high around 350 to making a new swing low in one session. That's how scary of a candle that was. But look at what's happened post that day, right? That's been sort of the low close now from for that period. We haven't undercut 300. So, taking a position, I would say just from a pure risk reward perspective, right? Taking a position and saying, as long as we hold 300, I'm going to be good. And if we break 300, I'm out. Like, I don't mind that, right? Particularly if we would be down in this area. And that's why buying, a retest of those lows, that's why following a support level like that can be quite helpful, right? Because you can clearly define your risk, right? You can clearly define the floor, and then you're just thinking of upside potential and what would validate that. So I think what's good about this chart is the risk is pretty well defined. The volume, as I mentioned, not quite bullish, right? Close to getting above zero. So, improved volume to the point that the Chaikin money flow goes net positive. That often happens, suggesting sort of an end of a big distribution phase, setting the stage for a period of accumulation. It hasn't happened yet. Maybe something I would be looking for to kind of confirm a breakout. But I think getting above the 200-day is pretty meaningful. So think about how the chart would allow you to structure the trade. You're long on a break above the 200-day, not a recommendation, but just a hypothetical here. Let's say you would do that. You define your downside risk at 300, which would mean as long as we hold those closes, we're pretty good. Upside at least to 350 to retest those previous swing highs. I mean, it's not the the most fantastic risk reward I could come up with, but at least a way to structure that and define it we break above 350, maybe that's where you add to the position on a way higher. So not a bad setup here. Also, I would say sort of a consolidation pattern, and again, very, very close to breaking out above the 200-day. I'm probably looking for some sort of confirmation, pushing above there in a way that would be that would sort of validate it. 3P Investor, thanks as always for watching. Is it a triple bottom on coin? Good question. Oh, like here. We're talking about like, 1, 2, 3. I don't mind calling it that. For me, patterns like a triple bottom, I usually just kind of refer to them as a support level, right? And that's kind of how I would think of it. But similar with Zebra, right? Sometimes the chart shows you how meaningful a level is. I was taught once is chance, twice is coincidence, 3 times is a pattern. I was taught that for support levels, right? So every time you test a support level or test a resistance level, that further validates that as a key level to pay attention to. So, what we're calling a triple bottom here just means we have now validated a number of times that for whatever reason, that's kind of where this stock, finds support, right? Meaning, and so every time that happens, sort of implies that that's kind of where buyers are coming in. We call that a demand area, right? An area where demand starts to increase. A level of resistance like that, we might call a supply zone, like an area where every time we get up there, just people seem to be selling. So like how much should my expectations be that we just break out finally? I'd probably be more hesitant about that. So yeah, I would say the more that we validate a level, if you want to call it a triple bottom or whatever, I don't have a problem with that. I think, for me, I just more usually define it as a confirmed support level, but 100% valid. I think that's a great way to assess the meaning of that price point on the chart. With that, I will say have a fantastic evening. Thank you for joining hundreds of my friends and tuning in live, those of you that are doing so. Thank you very much to the many others watching the show on the replay on our YouTube channel overnight. Please remember, your questions are very much appreciated and very welcome. We'll be doing an all mailbag episode on Friday. I'd love to answer one of your questions on the air. In the meantime, have a fantastic evening. Be well and stay safe. And remember, it's always a good time to own good charts. Take care, folks.